So the purpose of this application is to simulate buying and selling of fractional shares on the stock market and to see if this affects the end of day balance. So first, just to understand the simulation, over here we create a simulation of a day simulation, and our input variables for that are the number of transactions that are going to happen during the day, the number of buys and sells, the volatility of the given stock, the market tendency, so if we expect the stock to go up or down, and then the movement correlation. And the movement correlation just means that if the stock goes up, then the next transaction is going to be more likely to be a buy. So if the stock goes up by 10% and the movement correlation is 1, then the following transaction has a 10% higher probability of being a buy. If the movement correlation were 2, then the following transaction would have a 20% higher probability of being a buy. And if the stock had gone down by 20% and the movement correlation had been 2, then the following transaction would have a 40% higher chance of being a sell. Anyway, let's take a quick look at the simulator. So first, let's just prove that it's functioning properly. So here, this is the number of transactions in the day, and this is the volatility. So a volatility of 0.1 means that we expect that the standard deviation of all of the different stock prices at the end of the day are going to be, it's going to be 10%. So let's just run that. And as we see, the average stock price is 100 and the standard deviation is 1. If we go over here and we actually print out the stock price, here we're going to print now we can see, and I'm not going to run it, I'm only going to run it 100 times. We can see is what happened is we ran 100 simulations, and what I'm printing is the stock price at the end of the day. And sometimes it's $96, sometimes it's $115, $107, but no matter the end of day price, we see that when we average it all together, the stock has a $98 average price at the end of the day. And this makes sense because we don't expect the stock to move up and down. If we change this movement variability over here to 0.1, then we would expect the stock to end the day 10% up. So in this case, the stock ends the day with an average stock price of 111, around 10% up. And again, you see there's still days where we lose value. But again, we expect it to end up, so that's factored into our simulations. And as we also see, very importantly, the standard deviation is reflecting what the percent standard deviation over here, and that comes from the stock price always starting out as 100. I should have explained that earlier, but if you look over here in the day simulation, the initial stock price is always $100. Anyway, so back to the simulator. I'm going to simulate 1,000 transactions a day, and let me just get rid of this. So here we see, I'm going to put this back to 0. Again, the standard deviation is 10%, so the average stock price at the end of the day is $100 with a standard deviation of 8. If we make the volatility 0.5, this is a very volatile stock, we can expect, again, the average is always going to be 100 or around 100, but this time the standard deviation goes back up. But again, this isn't really what we're interested in, because so far all I've shown with the stock price is if we have a certain number of transactions and a volatility, what is the price of the stock at the day end? And again, the price of the stock at the day end, we don't expect it to move, should always be, the average should always be 100, but we just want to know what the volatility was. So that the volatility is being reflected accurately. Okay, so now we know that the volatility is being accurately reflected as shown by our test that the stock prices moves according to the volatility. And now we want to look at these other metrics. Over here, an input is how many trades, how many transactions. Over here is the market expected to go up or down, and here is the correlations between users buying when the stock goes up and selling when the stock goes down. So we want to look at all these different variables and see how they affect these two metrics over here, the end of day balance and the maximum exposure. So let's just briefly explain what the end of day balance is. The end of day balance is how much money we're expected to have at the end of the day after trading. So if the end of day balance is low, that means we lost a lot of money. And if it goes up, that means we made money. And then the balance of the beginning of the day always starts at zero. So really, the end of day balance just looks at how much money we expect to make or lose on a given day. And as I'm going to show, the end of day balance sticks right around zero. As you see, I'm simulating here, and it sticks right around zero. I think the highest one I've seen so far is making $13. There, we lost half a dollar. We made 3/4. We made 5. Let's see, we made 7. I want to go until we get a loss. Made 14. Made 10. Made 9. Come on, give me a loss. There we go. Lost $10 today. But as you can see, no matter what, it stays somewhat close to zero. And in fact, no matter what we do to any of these variables here, it's going to stay the same. We can move that to 0.1, and it's going to stick right around zero. It doesn't make any changes. Similarly, if we expect the stock market to go up a lot today, if we expect the stock market to go up 20%, or I should say if we expect the share that we're trading to go up 20%, we can run our simulation. Look, our share went up. It went up from $100 to $122 as expected. But again, the end of day balance, it doesn't move at all. And same thing goes for if we make users more likely to sell if the stock price goes down, and buy if the stock price goes up. Here, if the stock price goes up 10%, they're going to be 10% more likely to buy. And we see it doesn't make any difference. The average is always right around zero. So that's really important to know, because now we know no matter what, we can expect that we're not going to lose any money offering fractional shares. And this makes sense because every time you buy a fractional share, or I should say a user buys a fractional share, and we have to buy the rest of that share, we expose ourselves to some liability. But that's all going to balance out, because if a user buys a share at $100 and we for half of it for 50, so we buy the other half for 50, and then the share price goes down to $50 and they sell, so we incur a $25 loss, we can expect that over the long run, we're going to have just as many users who buy low and sell high, so we're going to actually make money. If we had that same scenario and a user bought for $50, a stock trading at $50, and they gave $25, then the stock went up to $100 and they sold. Well, the user's happy, they made money, but we're happy too because we just made $50. So it all evens out. I think we made $25 in that example, and we lost $25 in the first example. So it all bounces out, and that's verified by our model. And the last metric that we should play around with here is to just show that even the number of trades, even if we're only processing 10 trades a day, we can still expect that the end of day balance is going to be right around zero. If we pump up the volatility, if we make the market, the stock we buy, extremely volatile, we do see that that affects the standard deviation on that end of day balance, that standard deviation being the variability that we can expect to see. But again, in the long term, it always averages to right around zero. But again, we have a pretty high standard deviation. We only do a few trades every day and the volatility is high. On a day-to-day basis, we can see big jumps in how much money we end the day with. But perhaps even more important than how much money we end the day with, because we almost intuitively knew that in the long run, trades were going to balance out and we were going to end up just fine. We're curious about our maximum exposure because at any given point in the day, we could have lost money. If our first trade comes in, same scenario, someone buys half a share and the share is worth $1,000, they put in 500, we put up 500, and some crazy scenario happens and that share loses half its value and then the user sells, well, suddenly we just lost $250. So we are curious about our maximum exposure. And even if we recoup that by the end of the day because other trades happen and the shares that we buy, that portion goes up, we have to worry about what our maximum exposure was. And so that's what this metric down here is all about. And as we see, the more trades we process, that helps to put a sort of damper on the maximum exposure. Actually, I think I said that wrong. The number of trades that we process really has no influence on the maximum exposure. Um, Here we see that when the volatility is 100%, that's extremely high, much higher than any stock would ever be. We see that the maximum exposure on average is around negative $200, meaning at one point we were down $200 trading on a stock that was worth 100. And the standard deviation is pretty high, but if we bring this volatility down to something more reasonable, we see that the maximum exposure comes way down, it halves itself, it's around the value of the price, and the standard deviation also becomes very small. So kind of to sum up, and here we can make, if we processed here, I think now we're processing, here's 100,000 trades a day. I'm just curious. Yeah, so interestingly, the number of trades that you process really has nothing to do with your maximum exposure. And really what it comes down to is the only thing that affects your maximum exposure is the volatility of the stock. In fact, when we process fewer trades, it looks like our maximum exposure comes down. But again, if we pump up the volatility, we can expect that probably this maximum exposure is going to go higher, and similarly the standard deviation is going to go higher. But just in our final test, yes, the standard deviation went higher in this case. The maximum exposure didn't go much higher. So it seems like there's a little bit of interplay between the volatility and the standard and the number of transactions. So this time, for example, if I'm processing 100 transactions with a volatility of 0.5, that spikes up the maximum exposure. Look, when I go down to 10 transactions a day, my maximum exposure is only $50. So in this case, let's see if we put this at 1, maximum exposure doesn't change. If we put this at 100, so we do see that there is some sort of, until you reach a critical mass, your maximum exposure is affected by the number of trades you process. But now if we process 10,000, the maximum exposure hardly moved. But if we pump the volatility up, now we saw that's getting bigger. The standard deviation is getting bigger. Let's put this up to 1. That's where we saw those really big numbers. And the last test I want to run is just to kind of see where this caps out. And to do that, I'm just going to assume that we are running 1,000 trades a day, and I'm just going to run this with here, I'll just run this with 2. I'm going to do this manually. But you can imagine we can, and here, so alright, the exposure keeps going up. Thing is, this is outside the realm of possibility. There's no such thing as a stock with a volatility of 300%. So assuming that no stock ever has a volatility greater than 1, and assuming we're processing 1,000 to there, a million, this might take a little. Oh, it didn't take too long. To a million trades, our maximum exposure never goes more than around double the price of the stock, with a standard deviation of around double the price of the stock, which means that we're never going to go outside of 4 standard deviations. But when we extrapolate that across the breadth of the entire market, that means that we basically have to own twice the total number of shares in the market. So if Apple's worth 100, Google's worth 700, that's combines to 800. Then we factor in, so basically just one stock of every share in the market. So like an index of the S&P, for example, that would be how much we have to own, double that, and that's the maximum liability. So the S&P, if you compile each share, that's $42,000. So if we had $100,000, we could be sure that on any given day we could support any number of trades coming in. With just $100,000 base capital, we could support any number of trades coming in. And finally, and also very important, we would expect that in the long run we would have zero losses. So even though at any given time we could be eating into that $100,000 capital, maybe we're down $50,000 for the day, by the end of the day we're almost definitely going to have seen no movement. In the long run we are guaranteed to have seen no movement. So thank you very much.